Happy Monday, everybody. I hope you had a great weekend and are ready for another week in the trenches, as some would say. As always, I want to remind you that our overall thesis we run with is that we are long-term investors for the most part, and that our goals, not the day-to-day market action, will determine the plans we make, the plans we execute, and monitor and make necessary changes to. This is what we do. So please enjoy the deep dive into what's going on day to day, but also please come back on Friday for another planning video. We're also in the middle of a multi-part series on that video regarding education savings as the kiddos are all home or at camp. Otherwise, let's get into this. Today is July 18, 2022, and this is your Monday Market Update. Let's start with the recap of last week. It seems like forever ago, but stocks dropped sharply on Monday with lockdowns in China coming back into the news. More evidence that the zero COVID policy is not dead yet. China announced that most of the businesses in Macau, mostly known for the casinos there, will be shut down for a week. This is not what the market wants to hear. Recall that one of the pillars to the market finding a bottom is the second largest economy on the planet being open for business. News was slow aside from that on Monday, but as the day wore on, reality hit about the fear about last week's CPI and PPI report and all the rest and all of the rest. It weighed on the averages and it closed near the lows for the day. The Dow down 0.5%, S&P down 1.15%, and the Nasdaq down 2.25%. Oil finished down slightly after a 2% sell-off due to demand fears. Remember, we talked about demand as we keep talking about supply. We will continue to see commodities bounce around. We're focused on the Chinese demand with and without lockdown. Oil supply, big news this week for that news. Nat gas flow in Europe. We're going to find out about this pipeline from Russia this week. And overall demand. Is a recession bad enough to offset the supply shortage? We're going to find out. The dollar keeps rising, and we'll hear about this as earnings from the multinationals come out. Remember that 40% of the S&P revenues come from overseas. Higher dollar does not help that. The 10-year yield is still below 3%. Remember the short trip that it took to 3.5%. The 10s and 2s are still inverted. Tuesday came along, stocks opened flat ahead of the CPI report on Wednesday, PPI on Thursday. Disappointing eco data from Germany and France. Sentiment keeps getting worse. The NFIB small business optimism dropped again. That matters since we know how much of our economy comes from small business. Just another data point at a 10-year low. Stocks fell to new lows early, but then turned back positive with good corporate news from American Airlines and PepsiCo. Not all the news is bad. Fed head Barkin was a bit hawkish, talking about high inflation. Quick note on inflation. Costco will do their best to hold inflation down. That hot dog and drink combo at Costco will stay at $1.50. There's something. Hey, they throw in the heartburn for free. The final hour of the day, the market hit new lows, even though there was no catalyst. Maybe just positioning for the CPI. The euro and the U.S. dollar are at parity for the first time since 2002. The 10s keep getting more negative, and gold even hit a 52-week low while no one was looking. Prime Day is in full swing. All indices down. The Dow was down. The Dow was down a bit more than 0.5%. S&P and Nasdaq both down just under 1%. Post-CPI print Wednesday opened lower as the print was hotter than expected all across the board. But as the day went on, the buyers were back, and despite all the supposedly bad news, hope springs eternal. Not sure what drives that, but hope took the markets back up. Not much else could account for that. Dow and S&P down about 0.5%. Nasdaq almost made it positive on the day. Inflation, well, what we don't see at Costco, we have in New York City, up 29% year over year. Average monthly rent in the Big Apple over $5,000. Many are encouraged that although CPI came in hot, that it is backward looking. Prices are down this month. Remember, oil, corn, metals. Let's see how that works out. But again, those are coming down. PPI led the way on Thursday, equally as hot as the CPI on Wednesday, so stocks gapped lower at the open. With all this hot eco data, the market was pricing in a 100 basis point move at the end of the month, and then more to come. So we also saw jobless claims ease up a little bit also. A late morning rally started after Fed head Waller talked up a 75 basis point move over 100, and then a soft landing is still possible, according to what he said. Remember that hope I mentioned. He has it, and he is banging the drum. That did make markets feel better. It took expectations for a 100 basis point move by the Fed from 80% to 50%. That helped the hopers. So that took the market higher. S&P and Dow down slightly for the day, and the Nasdaq, hold on to your chair, positive on the day, very slightly. The weekend is strong. Friday was a full risk-on day. Dow closed up over 2%, S&P just under 2%, and the Nasdaq 1.79%. Left them all down for the week still. The relief rally was all about the bet that the Fed was going to moderate. Recall, I have told you that I don't think they'll be able to do all they say they want to do, but as the markets get excited for that, remember, why they're doing this. Inflation. So yes, are we setting up our catalyst? Recall, peak hawkishness from the Fed. That was the bet Friday. Peak inflation. Well, CPI and PPI are still hot, but if you figure the drop in prices this month, I think gas prices are down 31 straight days at the pump. Maybe the fist bumps in Saudi Arabia will help the price of oil. We have heard and seen that over and over again that OPEC cannot do what they say they can do now. Can they even add more supply? Big shocker of a number on Friday was the positive retail sales number. Backs up everyone who keeps saying that American consumers still have plenty of money in their pocket. Make no mistake, this is not the end of volatility. The good news commentary is still coming on the heels of news that was not as bad as feared. Again, not a ringing endorsement. I feel it's sort of kind of like what we felt when our kids were young. Our pediatrician, an amazing doctor and a friend is South African, and everything she said, whether it's a broken bone or they need stitches, no matter what, sounded better with her accent. It's amazing. So, not as bad as feared. Still need stitches. We'll see how long the patient feels soothed by the accent. Overall, we're in for a very slow and quiet week of the normal eco data. We will have a quiet period for the Fed heads. So who will steal all the oxygen in the room? We are set to hear from central banks around the world, the ECB, BOJ, BOE, and even RBA. But really, just some housing data and a bit of the normal jobs data to top all that with some manufacturing data. I don't think the eco data will be the mover. Earnings, though, here they come. After the banks kicked off last week, mixed results from JP Morgan and Morgan Stanley. This week, get ready. Bank of America, Goldman Sachs, Schwab, IBM, J&J, Netflix, Lockheed Martin, Tesla, United Airlines, Union Pacific, Verizon, and that's just a partial list. We'll be watching for our keys to the market. Remember, peak hawkishness, what news will drive that peak inflation, and what data we can get on that. And if we can get any movement geopolitically, Russia and Ukraine, remember them, it will make a difference. Watch out. This week we'll find out if Russia restarts the nat gas pipeline that they took down from normal maintenance last week. Back up or stays down. It will make a huge difference in Europe. Warning, since it did catch some people off guard this past week's stocks, but Google parent Alphabet is due for a 20-for-1 stock split. So unlike many of the work from home stocks and the crypto that split in price only, this one will be 1/20th the price, and you'll have 20 times the amount of shares you had. So if the stock splits confuse you, let me know. Okay, that lays it out. Full week last week, a bunch of earnings this week, and much more to come. Remember that earnings overall drive markets. Inflation affects earnings, but overall, long-term, earnings have been one of the key factors to the markets over time. We're going to finish where we start. Come back on Friday for the planning video. Keep in touch, stay nimble, and stay in touch. Have a great week.